Welcome to the latest edition of the Goals-Based Investing podcast series. I'm thrilled to be joined today by my good friend, Halvard Kvaale. Halvard, welcome.
Thank you, Tony, for having me, and congratulations on your book.
Well, thank you. Thank you. So today we're going to talk about asset allocation and portfolio construction, and I can't think of a better person to have the discussion with. We're certainly dealing in a challenging environment, lower expected equity returns, lower yield than we've had over time, increased volatility, and of course, this new thing that we have to worry about, inflation. How do you see the world? What are you looking at when you're looking at the markets today?
Yeah, it's clearly a difficult investment environment in the start of the year and an uncertain outlook. With the stock market just ending the first half, seen its worst first half since the global financial crisis, inflation at 40-year highs, interest rates have spiked, oil has doubled, and cryptos and seems like a free fall. Let's keep a long-term look at things and remember that we've been through a very strong and long bull market in stocks and bonds since the global financial crisis and before that for bonds. So we were really due a market correction, and risk had been historically low for a long time. So I really like to try to maintain a long-term perspective and take a look at what happened in the past when we had corrections like this. You can learn a lot from that. First of all, we as an industry have been forecasting lower equity returns for a long time, for well over a decade, and we were wrong. In the past 10 years, the S&P is up, after this correction, still up over 10% per year. So that's pretty good. Past corrections have been opportunities to take on more risk, not to reduce risk, in my opinion, and not to sell equities, right? It's usually too late after the market is sold off and gone into a bear market. So I'd like to, try to use these types of opportunities as, ways to, rebalance, maybe reposition the stock portfolio, but certainly not, reduce equity exposure after, the market has gone into a bear market. We might have a recession right in the next year, but remember, the stock market is a discounting mechanism and typically bottoms well before we know we're in or out of a recession.
Yeah, and thank you, because that is kind of sound advice. I think our typical reaction is often emotional, and we feel uncomfortable, and we and our clients think about heading to the exits, and of course we need to take that long-term perspective. But I did want to maybe take a little bit of a different sort of tilt, because I certainly have been challenging people to expand their playbook. And specifically, I've argued that merely allocating to stocks and bonds, and in fact, what we noticed over the last couple of years is most people allocating to U.S. stocks, right? Because you're rewarded for having exposure to the U.S. and the international or emerging markets were a lot more volatile. But I'd argue advisors today need a different toolbox. And specifically, I think alternatives are really valuable tools in environments like this, whether it's looking to increase your returns, pick up incremental yield, dampen the volatility that we're getting with these market shocks, or this new issue that we'll get into a little bit deeper, and that is inflation. And again, we haven't had to really solve for the impact of inflation, but as you pointed out, inflation's at a 40-year high, and there's no signs of that abating anytime soon. So what do you think about alternatives, and what role do they play as you think about your broad asset allocation strategy?
Yeah, no, that's a great point. And I think obviously alternatives should play an important role in the portfolio going forward. But I just want to go back to a little bit to the equity markets for 1 second, because I did, there's some interesting stats. If you look at, previous corrections or bear markets, 20% or close to 20%. I took a look at sort of back of the envelope calculation to see what the market did post, the last 5 since 1987 corrections of this magnitude. And if you look at the returns past for the next 5 years and 10 years after, I'm not trying to time the market here, but I'm saying, okay, if you've had a 20% correction, start the clock the following month end, or beginning of month, and then see what the 5-year return and the 10-year return have been, right? So if you do that for the, in 87, late 90s, 98, 02, 09, 18, and 20, you find that the average annual return in the equity market, as represented by the S&P 500, was the next following 5 years, 11.5% per year for 5 years, and 10.5 approximately for the next 10 years. There's only been one period, and this was in the period after the 98 correction, where the market didn't return over 10% for the next 5 and 10 years or 5 years. So I think stock market is a good place to be going forward. Don't give up on that, but the other components of the portfolio construction, I think, have other issues. So bonds, as an example, obviously it's a very different stories. We've been through a 40-year bull market in bonds. We're likely to see higher interest rates, certainly if the inflation stays high, which will limit the long-term returns of bonds, right? And so you have to look for other places to get yield, as you pointed out, and to get diversification in your portfolio. So we are probably moving to a more normal bond yield environment, right, than we've had since the global financial crisis. So looking elsewhere makes a lot of sense. But the flip side of that is that as yields go up, and the stock market keeps going up, whether it's high positive returns or low positive returns, correlations will actually come down. So that there's still diversification to gain from bonds, but the returns won't be that good. So in terms of inflation and hedging that, I would say the main tool that most investors should utilize is still the stock market, right? Because the stock market have exposure to real assets, right? The broad indices have anywhere from 10 to 20% exposure to REITs, materials and commodity like, equities, like oil companies and gas producers, et cetera. So those are good long-term, inflation hedges. And so the stock market in sort of a higher inflationary environment over long periods of time will be a good, hedge to inflation, in my opinion. So don't give up on that. But then, yes, alternatives should probably play a bigger role in the portfolios going forward, right, than it has over the last 10 years. I think private equity has done really well over the last 10 years, but, hedge funds have had a difficult period, and hopefully with higher volatility in the market, and more, more optionality and ability to add value, it might be a better environment for hedge funds.
Yeah, and maybe I'll just kind of pick up on that a little bit. I think that you're right. I think clearly today there's a lot of interest in private equity, private credit, private real assets. So the private markets are getting a lot of interest, and I think justifiably so, right? I mean, part of it is product evolution. Now they're more available to a broader group of investors, but part of it is that illiquidity premium that's built into those strategies. But just on hedge funds, I wanted to pick up on that because you're so right. And I think you and I both heard a lot over the years, well, hedge funds really failed to deliver on the promise. Well, in a rising bull market, most hedge fund strategies are going to lag. And I think there's also this perception in the marketplace that all hedge funds are created equally, where in fact, you and I know that equity hedge and event-driven or more equity surrogates, relative value is a strategy designed to pick up nickels, dimes, and quarters. And then macro is really a more defensive strategy, a strategy that actually does well when you get this volatility that we're going through now. So to group them all together and expect the same outcome, I think you're setting yourself up for failure. And again, when I think about alternatives, I think about trying to break them down and what is it they specifically solve for. I think they're really valuable tools, but they've got to be used the right way.
Yeah, that's right. You're completely right on that. And due diligence, and you have to do the work on which hedge funds or which private funds that you want to utilize to make sure that they fit in the portfolio, and what is the purpose of those funds, right? So right now I would really focus more on the hedge funds that provide diversification to equities, right? Credit, private credit, managed futures, and then commodities, obviously is having a good time right now. And although they've come off a little bit, but I think those 4 types of alternatives will provide great, diversification and good returns, I think, going forward relative to certainly relative to bonds, right? And be good diversifiers to equities. So private equities, I have I'm a little more challenged on that because, private equities, do provide for higher equity or higher returns than many of the other alternatives potentially. But with rates going up, it's going to be a tougher environment, I think, for many private equity funds to provide the same type of returns as they have been providing in the last 10 or so years. And additionally, private equity, is really equities. It's just a different way to get equity exposure, and you're smoothing out the mark-to-market volatility. So does it really provide diversification to public equities like other types of alternatives do? I don't think so. Because if you do, and we did this at my my previous firm, we did the analysis to unsmooth the private equity returns, and when you do that, you actually get to the same volatility number as public equities, and they're highly correlated to public equities. So private equity might look good on the surface the way it's reported, but when you dig through the numbers and do the statistical analysis to unsmooth it, it doesn't look as good, right? Yes, the returns can be higher, but the diversification benefit isn't as good as it's going to be for private equity or private credit or managed futures or commodities.
I would agree with that. I think you raised something that's interesting, which I think sometimes people lose sight of. So the nature of private equity is you're subject to stale pricing, right? It's not like the public where there's a constant discovery. So I agree with the methodology of desmoothing the returns. Desmoothing the returns give you a more realistic picture of what the true volatility is. But I would argue that you're still getting the illiquidity premium. So to me, I have private equity in my portfolio for returns. I think of my diversifier, I think of things like natural resources or real estate, private real estate, of course, being different than public real estate. But I do think there's a lot of these ingredients, if used well, that can help solve for the challenging environment that we live in today. But again, I think a lot of advisors struggle with this because they either think of all alternatives created equally, or they think of all private market solving for the same thing, where in fact they're very precise tools that need to be used in the appropriate fashion. If I could, Halvard, I just wanted to go back on something you said in the beginning, which is, yes, of course, we want to remind everyone of our long-term strategy. And we're not going to react just because there's a lot of noise in the market. But I do wonder, and you and I have certainly spent a lot of time together at our Morgan days, and then since then, talking about being more tactical. Is this an environment where being a little bit more tactical makes sense? And if so, what sort of subtle tactical shifts should advisors think about for their clients?
Yeah, no, it certainly seems that way, right? There are opportunities to add value, right, by tweaking the portfolio, and but timing is very difficult, right, or almost impossible. Wall Street is littered with strategists who have made one or two great calls, right, and never really been able to consistently deliver on that going forward. So if you're going to be tactical, it should be, in my opinion, on the margin. First have a solid long-term strategy, and then you can move things around on the edges. So, all my comments earlier too, relative to private equity and others, you should have an allocation to it. I'm not saying you should not have that, but again, now might not be the time to go and increase it a lot, right? So, but play around on the margin, which obviously is also very difficult to do with privates. But in terms of stocks and bonds, yeah, I would say first, in terms of being tactical, take advantage of rebalancing opportunities. That's kind of a tactical discipline, in my opinion, that adds value over the long term. Buy after it's sold off and sell when it's too high on the margin. And then, if you have a strong view on certain asset classes or styles or areas of the market, do it in small increments, right? Because it's difficult to do consistently in terms of adding value. Certainly for my portfolios and the portfolios I've been involved in, we've always had a tactical, component, but again, it's a very risk-controlled tactical element to the portfolio. The strategy, the long-term strategy drives the returns, and then you try to add a few basis points here and there through tactical overweights and underweights, whether it's, US stocks over foreign stocks, whether it's stocks over bonds, right? Things like that. I don't claim to have the insight to overweight sectors of the market, but for the bigger asset classes, I think it could make sense to do a little bit of that.
Halvard, thank you for your wisdom. Thank you for your calming, sobering sort of view on the world, because I do think you're right that the temptation is to get off the rails, where we really need to remind ourselves what's the long-term strategy. If there's opportunity to make subtle tactical shifts, probably being more defensive makes sense in this environment, but not to completely depart from our long-term strategy. I'd argue that for advisors who have embraced alternatives, they're valuable tools. Think about it, including them, not just because today is a difficult environment, but on a long run basis, they're really versatile and valuable tools that I think can help solve for a lot of the needs that our clients face. I thank you for your time. We'll have to do this again because I think there's a lot of information to cover, and it's impossible to do in a short little podcast, but I appreciate your time and I appreciate your friendship.
Great. I appreciate it, Tony. Thanks for having me on.